Market is near the day's low as earnings uncertainty drives caution. Realty stocks lead the charge while consumer durables drag.
And Just Dial gains on posting record margins while Angel One perks up as revenues per client rise, but TV18 slips as profits crimp on scale-up of new verticals, and Quick Heal falls after sales dip in a seasonally strong quarter.
China reports growth of 4.5% in the first quarter of the year, ahead of 4% expected, sparking a rally in oil and metals. Hopes of stimulus to revive the soft pockets of the economy also buoys sentiment.
And Tata Chemicals sulks on a dip in soda ash prices, but Coca-Cola's investment in an associate boosts Jubilant Foodworks and hopes of divestment drive up BEML. Hey folks, welcome to Halftime Report. I'm Sonia Shenoy and with me is Ekta Batra. Well, the market is really quiet today. Not too much happening in terms of a headline index movement. After yesterday's downfall, the market is sort of just consolidating in a very, very tight range. The good part is that the mid-cap index is doing well, so lots of stocks up and about. In fact, the mid-cap index is up almost 160 points. And, you know, whether it's the railway companies, whether it's some of the pharma companies that are doing well, banks are picking up a bit. So there are some pockets that are looking pretty this afternoon. And that's keeping the markets afloat. In fact, the Bank Nifty is the one that's leading the charge today. So the Bank Nifty is well in the green, up about 150 odd points. So clearly the focus has shifted away from IT and to the banks, and that's what you can see on the screen today.
Hi Sonia, yes, absolutely. You know, we've seen that for the Nifty Bank in the past couple of trading sessions as well, where there's been some kind of outperformance, some kind of resilience, considering that the Nifty Bank has gained for 4 consecutive sessions. Separately, we do have a couple of banks to watch out for in terms of numbers. ICICI Bank as well as Yes Bank will be releasing numbers on Saturday. So let's see whether the trend continues in terms of what HDFC Bank put out when it came to asset quality and other parameters. As of now, we have Indices Bank, which is not doing too badly either. So that stock on a week-to-date basis has already garnered around 3% odd. And month to date, it's already picked up around 7% odd. And currently, the top gain on the Nifty up close to 2% odd. But let's talk about a couple of broader market stocks. Let's start with Angel One, which is surging trade. This is on the back of a good set of numbers. Surbhi is here with us to decode the numbers for us.
Thanks for that. So Angel One is in focus. That is because of its strong Q4 numbers. Now the Q4 numbers were pretty strong given the volatility in the capital markets. The revenues were up 10% at 826 crores. Their EBITDA was up 20%, and this was largely because of lower employee expenses. Employee expenses were lower by 33% sequentially. The margins came in at 45% versus 41%, and the PAT was up 17%. The average revenue per client, that was also up 3% sequentially at 427 rupees. Looking at some operational data that came in, the total client base was up 10%. The gross client acquisition for Q4 was up 31%. The number of orders, that was up 16% at 26.3 crore orders. And the average daily turnover, that was up 28% at 1.85 lakh crores.
Okay, thanks a lot for that. But the other stock, which is a big mover today, in case you missed out on it, is Just Dial. A good set of numbers is what the company reported. Healthy growth in revenues both sequentially and year on year. Reema's here with more details. Reema, over to you.
Thanks so much for that. So numbers are looking good. Revenues have gone up 5% on a quarter-on-quarter basis, nearly up 40% on a year-on-year basis, and things are finally getting back to normal. Now, Just Dial caters to the SME segment, and they were hit hard post-COVID. So now, finally, after 2 years, numbers are getting back to what they were pre-COVID. So this quarter's quarterly revenue at 232 crore is very close to Q4 of FY20, revenues of 234 crore. So as I said, things are now finally getting back to pre-COVID levels. Margins too have improved on a quarter-on-quarter basis at 14.4%. These are the highest levels in the last 2 years. Cash in the books is strong at 4,067 crore, and the company said that they will use the cash in the books either for their organic growth or they could look at an inorganic growth as well, considering that adjacency acquisitions are now at far more reasonable valuations. The only little bit of a slip perhaps is the paid campaign growth at 16,340 crore. It's lower than the recent run rate, but then the company said that this is natural. These are quarterly fluctuations, and therefore they would not read too much into it. Listen in to what the management had to say about the growth, margins, and the outlook going forward.
As we move forward into fiscal 24 and as our revenue converges with our collections for this year, this margin should sequentially keep on seeing an uptick, which is visible in last 2 to 3 quarters as well. So on a long-term basis, I think this business requires 6 to 7% of our top line to be spent on advertising. It could fluctuate a bit on a specific year basis. For coming year, I think anywhere around 35-40 crores definitely we would want to spend. And further increases could depend on how things are panning out. B2B segment revenues were about 26% of our overall revenues last year. And overall, in last 2 to 3 years, this particular segment has obviously outgrown the B2C side of revenues. And we expect such outperformance to keep continuing in coming years as well.
Okay, well, Just Dial is up and buzzing, but on the opposite end of the spectrum is Quick Heal. That stock is down around 7.5%, trending closer towards its 52-week low, which stands at around 127 rupees. And currently the stock is at around 136.8. Rima is still with us to decode those numbers for us. Rima.
Thanks so much for that. So Quick Heal is a security solutions provider, and they've been hit hard this quarter because companies have lowered their technology spend since H2 of FY22. That's the reason why quarterly revenues are down 26% and year-on-year revenues are down more than 50%. Remember, Q4 is a typically strong quarter, but this time it's not happened. Revenues, as I said, are down 50% on a year-on-year basis because the companies have brought down their spend. In fact, the company says there's a sudden decrease in IT spending since H2 of FY22, and they foresee the same trend going forward. Now, because of the sharp drop-off in revenue, the company has also reported losses at the operational and the bottom line level. EBITDA loss stands at about 16-17 crore, while the bottom line loss is at 6.6 crore. Back to you.
All right, thanks a lot for that. So that's on Quick Heal and the reason why the stock is under pressure. TV18 is also under pressure post its numbers. In fact, both TV18 and Network 18 reported numbers. Survi is here to tell us why we are seeing such a poor performance. Survi, over to you.
Thanks for that. So TV18 is reacting to its numbers. Now, it's a pretty weak set of numbers. The revenue was down 6%. The EBITDA was down 70% on a year-on-year basis at 77 crores. Margins have come in at 6% versus 17% same time last year. And profits are down 75% at 35 crores. But if you delve deeper into the numbers, the news segment has done pretty decent. The news revenue was up 4% on a year-on-year basis. And the news EBITDA is down only about 12% on a year-on-year basis. The TV news EBITDA on a sequential basis has shown some improvement, and weak ad environment that has impacted the overall profitability. It's the entertainment segment which has dragged down the EBITDA. The entertainment revenue was down 9% at 1,045 crores, but the entertainment EBITDA, that was down 93% at 12 crores versus 180 crores same time last year. Now, the company is continuing to scale up its digital and sports vertical, and because of the investments in these verticals, it is facing EBITDA losses. Key triggers that could work for the stock going forward is the strategic partnership with Reliance, Bodhitree and Paramount, which was announced over the weekend. So now they have 15,000 odd crores in their kitty to expand this digital segment. So that could be a key trigger for the stock going forward.
Okay, all right, Surbi, thanks very much for that. But let's move over to our special segment then, Quarter Se Quarter Tak. Sonal is here today to take us through the expectations from the oil and gas space.
Well, it is largely going to be a good quarter for the oil and gas sector due to better realizations, and also fundamentally, this quarter is supposed to be better. Remember, crude prices, they have declined sharply, around 19% on a YY basis, 8% sequentially to $81.2 a barrel. And on the other hand, Singapore GRMs, they have increased to levels of $8.2 per barrel versus 6.3 earlier. And this is something that will show in Reliance's earnings, which will see an improvement led by the O2C or oil to chemical segment and lower windfall taxes as well. Overall, this would lead to an EBITDA increase of 5% on a sequential basis and on a consolidated basis as well for the company. For oil marketing companies, lower crude and higher refining margins will definitely be a positive, but a bigger turnaround will come in from the marketing segment, and that is where improvement will be seen. in both the segments and will lead to a 77% sequential surge in EBITDA and 3.3 times increase in PAT according to ICICI Securities. For upstream companies, even though crude prices they have declined, realizations post-taxes have been around $72 to $76 a barrel, and gas realizations have been stable quarter on quarter, so this will see a set-off. Overall, high other income will aid earnings for oil producers this time around. City gas distribution companies will see a mixed bag where MGL will see the best performance. MGL took sharper price hikes versus IGL, and hence the EBITDA performance is expected to be better. Gujarat Gas will see a weak performance this time around, led by lower demand in the industrial segment. Nirmal Bang estimates that Gujarat Gas will see 26% decline in EBITDA YOY. IGL will see a 12.5% increase, but the biggest rise will be 72% increase in MGL's EBITDA. Now for gas utilities, GAIL and GSPL will see a weak quarter due to supply shortages from Gazprom and also weak demand, while Petronet LNG will see better numbers. That is because of lower spot LNG prices. Leaving you now with the valuations, all producers are still seeing compressed valuations. So around 3 times is what is the number for ONGC. Reliance Industries is at 21.6 times. If we talk about BPCL and HPCL, BPCL still continues to trade at a premium. MGL, which is expected to do well, is the cheapest in the city gas distribution space at around 12.8 times, and the others are higher here.
Okay, all right, Sonal, thanks very much for that. So that's on the expectations from the oil and gas space. For the markets, the mid-cap index is what is really shining through today. So the mid-cap index is up around 175 odd points at the high point of the day, up around 0.6%. And that's really reflecting in the advanced decline ratio, which is holding quite steady on the Bombay Stock Exchange. So 2,000 stocks advancing for around 1,500 stocks declining at this point in time. As you can see, the graph is showing a bit of a gap and probably widening at this point marginally as well. Time for a short break. We'll get you more on the markets once we're back. Stay tuned.
Welcome back to Halftime Report. So today is not such a bad day after all. I mean, if you look at the broader markets, things are actually looking quite good. Just want to point out a couple of things. Real estate stocks are picking up pace. In fact, DLF is at a fresh 52-week high right now. It's had a great run. I mean, this year, this month, in fact, DLF is already up 20%. And the realty index is looking pretty smooth this afternoon. IGL is another stock at a fresh 52-week high. Glenmark Pharma is at a fresh 52-week high today. So, you know, a lot of stocks coming back. Cyient is also looking pretty good. In fact, talking about Glenmark Pharma, the focus has been on the pharmaceutical space for a while. The stock's looking pretty good. Lupin is also up about 2%. Any reason for that, Ekta?
Well, Sonia, you know, we've been discussing this for the past 2 weeks that pharmaceutical stocks have seen some amount of interest come back. So today we have JP Morgan, which is written on it, as well as Citi. So I'll start with JP Morgan, which has said that the Nifty Pharma Index is up around 6% in the last 1 month and has outperformed the Nifty by around 270 odd basis points. Now, 5 reasons that will drive the sector performance through the year, according to them. First is the India business, which is likely to see the highest price increase this year, aided by one of the highest NLEM, which is the National List of Essential Medicines, revisions. Secondly, price erosion trends are moderating in the US generics business versus elevated levels that we saw around 2 years ago. And they say that the opportunistic gains in US are arising now on account of increased drug shortages and supply disruption. Remember that drug shortages in the US are currently at a 5-year high. Now, they also believe that there is easing of input costs, freight cost normalization, which should eventually aid margins. And overall, the sector valuations are reasonable. So the sector valuation is at around 22 times 1-year forward PE, which is a 22% premium to the Nifty, with versus a 15-year average of around 33%. Now, top picks for JP Morgan are Sun Pharma, which is a solid domestic franchise, according to them. Continued ramp up in specialty, something they like. Cipla, continued outperformance in India, and peptides is seeing a strong traction in the US, which is a type of drug. Next brokerage which is written on the pharmaceutical space is Citi. They believe the current optimism around the US generic pricing may in fact be short-lived. So they're striking a cautious note on the US, which is contrary to what JP Morgan is saying. Citi says the biggest reason behind the continued pressure on generic pricing in the US would be an aggressive scale-up by small and new entrants in the US, which remains unabated. They maintain a cautious stance, and the product-specific executions would be important in the US markets. They maintain that Sun and Torrent Pharma are their preferred picks in the Indian pharmaceutical space. So that's what's buzzing in that entire space.
Okay, but the other space that we're looking at this afternoon is affordable housing companies. So Abhishek is joining in to tell us about a brokerage note over there and why these stocks are buzzing in trade this afternoon. Abhishek, over to you.
Well, Morgan Stanley has initiated coverage on affordable housing segment. They have written that there is secular growth opportunity in a systematically important sector. So the opportunity is significantly higher outside the top four, and especially where the disbursals, the ticket size is less than 25 lakh per disbursal. So space is niche, under-penetrated, has a secular growth outlook and is ESG positive. So thesis is stronger right now given the fact that asset quality woes are behind after the COVID impact that we have seen. Valuations have derated and peak rates, that is interest rates, are in sight. So valuations have significantly derated and are at now reasonable or let's say attractive levels. They prefer Aptus and Home First Finance given the fact that both have smaller balance sheet and hence higher loan growth potential as well as better business risk return profiles, and valuations are working for them. So for Aptus value, they have a 27% upside on their target price of rupees 325. For Home First Finance, they have a 25% upside with a target price of 900 per share. However, due to higher valuation, the target price on Aavas Finance is 1900, which is just 6% upside to yesterday's closing. And for Canfin Homes, they have an equal weight rating and a target price of 550 per share, which is a down of about 3.6% to yesterday's closing price. They say that the much larger ticket size as well as bank competition and promoter stake sale is actually an overhang on Canfin Homes. Back to you.
All right, thanks a lot for that. Well, the other space that we are looking at is the auto space. Now, CLSA put out a note where they're very constructive on the auto sector. They say that they've met a lot of clients across Asia, in Hong Kong, Singapore, etc. And most of their clients are bullish on the auto space for a couple of reasons. One is that the stock prices have fallen quite a bit, so it's looking attractive now. And the other reason is that demand is resilient, so demand is coming back as well. They also talk about how clients are optimistic about an EBITDA improvement both in FY24 and FY25. That's because of a fall that we've seen in the commodity prices. Now, a couple of things. Maruti Suzuki and Tata Motors are the most favorite four-wheeler stocks. And if you look at the two-wheeler space, it's Bajaj Auto because of the dividend yield factor. There are some positive triggers as well on account of the new launches, etc. for Bajaj Auto. They also talk about how for Tata Motors, there's an improvement in the Jaguar Land Rover volumes, there's a strong domestic business, and that's made clients positive on Tata Motors. So Maruti, Tata Motors and Bajaj Auto are the three stocks that most of CLSA's clients like, and hence they're optimistic on the sector as well. Let's slip into a break on that note, but lots more coming up on the other side. Sachidanand Uttekar of Trade Bulls will be joining in with some trading strategies. Stay tuned.
Welcome back. Well, it's a quiet day for the frontline indices, so the Nifty is just about holding 17,684 as we speak. But we have a lot of stocks which are buzzing within the Nifty space. So do watch out for HCL Tech, which is seeing a little bit of a comeback. Remember, it releases its numbers on Thursday, and that would be a set of numbers to watch out for, especially after what we have seen from TCS and especially Infosys. Separately, a couple of the pharmaceutical stocks, like we've been pointing out, have been buzzing. So Dr. Reddy's is up around 1% at this point. And banks have been doing well in the past couple of trading sessions. So there is buying in the big PSU bank, State Bank of India, which is up around 0.6%. Even a couple of others such as HDFC Life from the insurance space is seeing some amount of upside. Sachidanand Uttekar of Trade Bulls joins in on the show this afternoon to discuss the technicals. Then, Sachidanand, welcome to the show. Well, it seems to be a lot of interest in financials. Is that something that you're recommending to your clients? What would your call be on the Bank Nifty specifically, as well as specific stocks within the index?
Good afternoon, Ekta. I think both the indices are showing signs of consolidation to weakness, especially essentially, if you look at the Nifty, we were expecting a range of 17,000, 630, 650 kind of a support, and on the higher side, 17,750, would be serving as a resistance. So I think the Nifty is fairly placed within this particular band. The only concerning part is that in case if we see further slippages below 17,630 and a closing below the same, then probably we may see an extended pullback, which could lead the Nifty towards 17,520, where its 200-day exponential moving average is placed. So as of now, I think it's better to be on the short side when it comes to Nifty. But when we look at Nifty banks data, especially from the PSU names, which have been outperforming, so I think Nifty bank still has some headroom left for the day. We are expecting the range of around 42,700 on the higher side to be revisited, but on the lower side, I think 42,200 would be a very critical support. In case if that particular support is breached, then probably even Bank Nifty could show or display a very strong pullback. So as of now, I think there's no trade when it comes to Nifty and Bank Nifty, but I think most of the stock-specific action is providing us enough opportunities to take some positions during the day. So one of the stock that we have been following is Jubilant Foods. Already seen a short squeeze move here. We are expecting this particular rally to continue towards 478, and this is why we have recommended this particular position to our clients. The stop loss should be placed at 432, and long positions can be built in when it comes to Jubilant Foods. The other stock which has been on our radar is Pidilite Industries. For the last few trading sessions, we've seen very strong call writing at around 2,400 levels. Now, this particular level has been breached decisively. We're expecting this short covering kind of a move to take the stock towards its 200-day exponential moving average, which is placed somewhere close to 2,460. So again, here some longs can be considered on a pullback. The stop loss should be placed at around 2,386 for a positional target of around 2,460.
So that's Jubilant Foods and Pidilite, right? Two stocks that you like in that consumption space. All right, thanks a lot for joining in, Satchidanand. Appreciate your thoughts. We'll slip into a quick break. On the other side of the break, we'll get you lots more action on the market. Stay with us.
Welcome back, and let's focus on the deal street. And Prashant Mehra, who's a partner at Grant Thornton Bharat, joins us now on the show. And they've authored a report which has really given the summary of the deal flow in the first quarter of this calendar year. Prashant, always a pleasure to welcome you on CNBC TV18. Now, there's a substantial drop in volume as well as deal value on a YOY basis when it comes to the first quarter of this year. Enumerate what are the most important factors that have really led to this, and in the present quarter, are we seeing the same trend continue?
Yeah, Anisha, thank you for having me. I think what's happened in the first quarter of this calendar year is something that was really expected. The sentiment across the globe has been very tepid. Which is why we've seen about a 35 to 40% below last year, both in terms of values and volumes. Of course, large deals happening in the first quarter of last year has made this percentage even higher. But yes, I think just focusing on volumes itself, it's about a 30-35% degrowth. Having said that, what's encouraging is that if we look at the spectrum of M&A as well as private equity, the deals are actually across sectors. I mean, private equity, of course, has always been focusing on the technology sector as such, but it's good to see some industrial and pharma and real estate deals there as well. But moving on to the M&A side, there's no one sector that is coming across as favorite or a heavy sector. The deals are across, which demonstrates the fact that the market's still interested in making the transactions, but the sentiment is weak, so it's a bit wait and watch. Having said that, I think things are turning around. The signs in late March, early April of pre-deal activity is there. And hopefully in the next couple of months, I think the tide will turn.
Right. So the hope is that the tide will turn. But how is the private equity really poised? It has really shown a very, low amount of investments in the quarter gone by. And of course, private equity has been waiting for some bit of clarity and certainty on valuations. Is that really coming in, especially with the central banks looking at a pause now and not heightening the interest rate from here on, hopefully?
Yeah, I think it's a bit of both, Nisha. Private equity, largely has been focusing on the technology sector. We've seen this trend post-pandemic that it's not just about the revenue model, it has to be about the business model as well, which is why they've become a bit choosy in terms of, the deals that they're making in the technology sector, because it's not just the top line, but they need to see the business making money as well. As far as the non-technology sector or the everything else, they are backing consolidations where, yes, as you rightly said, they are expecting some certain valuation corrections. Private equity is looked at as an alternate means of financing. Since acquisition financing is not available in the country, there will definitely be a lot of consolidation. And I think just waiting for the right time for the valuations to normalize when they can start backing large corporates for consolidation financing.
All right, so consolidation and consolidation financing by private equity is one trend to watch out for. Another important aspect from the startup world, Prashant, is the IPO. We have seen several of the companies trying to make an attempt back into the IPO market, and that list has also shrunken over the last few weeks as valuation reality check really kicked in. How are you seeing the situation at the moment? How many could really fructify?
The quarter has been kind of tepid. We've just seen, 4 or 5 IPOs really. I expect that market to remain so because, frankly speaking, the retail investor is a large chunk of investors. And as inflation is soaring, not too sure what disposable incomes are available with people in terms of investments there. This will hopefully pick up once the the inflation is corrected. RBI, of course, is doing its bit, but we will need to probably wait for a quarter for IPOs to come back again.
All right, so some more wait and watch for the IPO game to really kickstart, especially for the startup. One important trend that really picked up in the last few months was the block deals and private equity making exits before the market went down further as there were uncertain times. And on the other hand, some of the startup investors also in the listed space got an exit through the block deals at the valuations were lower. So that was one trend. What are the few other trends that you're seeing right now and probably unfolding in the next few quarters?
I think as far as block deals is concerned, I'm not too sure if that will continue much because when the valuation correct, it's a time to buy and not sell. And yes, given especially India's growth story, the markets will turn around. It's just that the global environment is such that things are more wait and watch and tepid. But once the markets turn around in about a quarter or so, IPOs will be back and it'll all be about putting in more money than trying to monetize on what investments people have. So yes, in a month or so like that, and then we will see a lot of action starting in June. And in July onwards, I'm sure we'll see a lot more growth than even what we saw last year.
Prashant, while most of the uncertainties remain at this point and we still have to watch out, yes, on inflation front, on interest rate front, we have had some good news. But what are those factors which are giving you the confidence that from June, July onwards, things are going to be much better?
I think firstly, of course, it's inflation correction. But more importantly, the macroeconomic factors in India still hold good. Even if you look at the stock markets, yes, there are fluctuations because of global events, but nothing really from an India standpoint as such. The purchasing power parity is increasing. There is increased demand. There is investments happening in the evergreen sectors. All that will create employment. That will create investment avenues.
Sure.
And I think it's just a matter of time that, when the global large investors also start realizing that India is the market to really put in their money. And once we see money coming in, it will, start that domino effect of transactions going across sectors.
All right, so a lot of wait and watch right now, but tide is expected to turn very soon, very quickly. Any specific sectors where M&A you see picking up?
Industrial sector is something, and mainly driven by consolidation, is somewhere where we see a lot of activity coming up in the next quarter.
All right, Prashant, always a pleasure speaking to you. So a lot of optimism when it comes to the deal street and the tide really turning and investments coming in. Consolidation also is something that could be watched out for. With that, it's a wrap on this segment on Deal Tracker. Well, come back for more news and updates on the other side.
Welcome back to Halftime Report. For the market, there are a lot of stocks, as we were telling you earlier, that are in the green. So although the headline index may not reflect it as much, there are plenty of stocks with double-digit moves at the moment. One of the stocks in the auto ancillary space is Precision Camshaft. So that stock is up almost 12% and it is sitting at a fresh 52-week high. Now, we know that Vijay Kedia has bought about a little over 1% stake in Precision Camshafts. That one's been buzzing, and a couple of other names looking good. Pharma is the space to be in this afternoon, undoubtedly. Lupin, Biocon, all big movers. But the other stock we're staring at this afternoon is BEML. It's trading in the green after shares of BEML Land Assets Limited will be listing tomorrow. Vivek is here to explain that to us. Vivek, over to you.
Well, that's right. So BEML, BEML has now two divisions or two separate companies that we are looking at. So the news is that the equity shares of BEML Land Assets Limited, and as the name suggests, this particular company has all of the land assets and the real estate land bank as far as BEML is concerned. Now, this particular company was hived off, and it was hived off in the ratio of 1:1. So for every share that you held in BEML, you got a share of BEML, land bank. Now, there was anticipation as far as market participation was concerned that, this particular listing would have been the next possible trigger for the eventual divestment of BEML, and which is what is actually driving the move that we are seeing in BEML today. So now when we're talking about the way forward, this particular move clears the path for the government's partial divestment as far as BEML is concerned. Remember, the government is looking to divest almost 26% stake in the company via the divestment process. And at the end of the December quarter, the government held almost 54% stake in the company. Now, when you're talking about the value of this particular land bank and where exactly are we or analysts are expecting this particular stock to list at, so analysts say that the value of the land bank is now being anticipated at close to 8,400 crore rupees, which works out to a fair value of between 500 to 525 rupees a share for this particular stock itself. So now this particular stock would come into the T2T segment and will remain there for the next 10 trading sessions post the listing.
Okay, BEML buzzing in today's trading session. Vivek, thanks very much for that. The stock up around 2%. But the other one which has seen a sharp knock is Tata Chemicals, which is lower on the dip in soda ash prices. Sonal is standing by to tell us more about it. There is a Kotak institutional brokerage report which is indicating some details with regards to this. Sona.
Thanks a lot for that. Well, Tata Chemicals is in focus because it is the second price cut that we've seen in last 6 months. The quantum is around 3 to 4%, not so much, but the indication is that this could continue in the future as well. Now, it's a 3 to 4% cut across their light and dense soda ash products, which is in India only as a geography, effective from April 17th. And this is coming because of the cut that we are seeing in soda ash prices in Chinese market. Additionally, there is more supply coming in global markets. It is expected that Mongolia will see new supply from May 2023. This will make supply easier and will lead to more cuts in prices as well. And that's why there is incremental negative which is expected for the soda ash market as a whole. Uncertainties are remaining around demand and supply, and that needs monitoring as well, and something that could impact Tata Chemicals because 15 to 20% of their consolidated EBITDA comes in from soda ash itself. Now, a price cut should at least partially be mitigated by the lower coal prices, which is a major raw material for them. But the idea is that it has happened now, and there is an expectation of more price cuts, which is putting the stock under a lot of pressure. Kotak Institutional Equities expects Q4 to be strong, which will be led by the US markets. However, outlook for second half is very unclear, so to say, and this is something that they'll be tracking. Soda ash realizations are now correcting after continuous uptick in last 2 years. So that is something which is worrying the street right now.
Okay, thanks a lot for that. So Tata Chemicals, big losses coming in, but Avalon Technologies is the other one that's making a muted debut on Dalal Street today. The IPO included an offer for sale of 545 crores, and the company aims to use this proceeds for debt reduction and funding of working capital needs. Earlier today, in fact, we spoke with the company's chairman and managing director, Kunamid Vicha, and also their chief financial officer, RM Subramanian. Listen into what they had to say.
We're looking at it a lot more longer, three-year horizon. What we see immediately is that we will be growing faster than the industry. And since we're just listed, we cannot give the exact numbers out. Our anticipation is going to be faster than industry. We're seeing the orders come in from that. And we intend to keep our 51% and go larger. And the key goal was to give as much as possible as a percentage to the new stakeholders, and that's one of the reasons why the promoters reduced, and some of the other shareholders have reduced much more than what the promoters have done.
In terms of the IPO, and the primary purpose of the IPO is to make sure our growth is fully funded. You all know that the manufacturing sector and EMS is seeing a huge growth momentum because of the industry tailwinds as well. So the idea of the purpose of the IPO is to make sure the growth is fully funded. Bulk of the money will be going in debt reduction. We intend to maintain the working capital lines.
Weak listing coming in there. Just watch out for Divi's Labs, because that's all of a sudden seen some amount of interest. It's risen to become the top gainer on the Nifty. It's up around 2% at this point in time. And in fact, it's had a great month. It's a lot of the pharmaceutical stocks which are doing well. But as you can see, there's been a spike up that you've seen for Divi's Labs, currently at around 3,230 rupees for that particular stock. Gained around 14% on a month-to-date basis. Some sudden interest coming in for that one. Time for a break now, but up next, Manisha Gupta, commodities editor, will be with us.
Welcome back, and joining us now on the show is Pramod Damodaran. He's head at the India Techpreneurs Federation, and he joins us on the show. Mr. Damodaran, thank you so much for joining us. I want to talk about the cotton prices, where we did see all-time highs in the previous year and then a very sharp correction. Prices did decline by nearly 55% as well, almost to the tune of 60,000 and below those kind of levels. From where we are trading right now, with the fact that the crop is lower, the exports not so much, the demand is on the higher side, how are you looking at, first of all of those numbers?
Thank you, ma'am. Actually, the fundamentals factors are not supporting any bullish trend in cotton. I will explain in a few minutes. As per our estimates, we lost around 35 to 40 lakh bales of consumption in this cotton season because of the non-functional of mills in the last quarter. Okay. Even today, the utilization levels of spinning mills in southern state and some northern part of India is less than 15% compared to the historical average. So still 5 lakh bales of routine consumption we are losing month on month. And third reason, yarn, fabric, or the entire ecosystem now working on start and stop purchase mode. What is that? Actually, people are purchasing little quantity and slowing down and again coming back for buying. It is not only in domestic, even international players also doing the same to keep the check on prices. So the entire value chain is not achieved much momentum in the volumes. And moreover, our major buyer of yarn, China, is slowing down and not expected. We expected Chinese recovery will come back and they will come back for a big level of buying. But that is not happening. They are also doing the same kind of a stop and start approach. 1 month they are buying, and again 1 month they are giving a gap. So there is no momentum for yarn or fabric or any category of products in textile value chain. So naturally, this reflects in the lower level of utilization of spinning mills in India. And again, margin front also, still spinning mills are making either minimal loss or working with 7 to 8% EBITDA margins. It is not at all sustainable. So things are not
Mr.
so
Damodaran,
good in the
I
value
want to.
chain.
I got that. Mr. Damodaran, that's not what we seem to be hearing from all sectors within the industry itself. Would you say that this is quite geographically put out, as you would say? How is the demand really coming in from the southern part of India right now? We do understand that in the global markets, the trade is at perhaps a 6-year lows. The export numbers have been not so great as well. But going forward, with the kind of arrivals that we've seen into the Indian market, how are you looking at that?
Actually, arrivals are good. Still, farmers are holding the material. Okay. We are very confident material will be available for Indian spinners throughout the season. And moreover, very important factor, as you said, it is not geographical. Across India, there is a slump. I am not telling that the recovery is not there. Month on month, we are seeing an improvement. Buyers are only doing a calibrated buying. Even in apparel exports, all the apparel export from our side, southern part of India, they are telling the international buyers indicated that 30% lower volume they can expect for this year. That too, routine normal recovery will happen only in the H2 of this financial year. So the calibrated buying is there, month on month improvement is there, but the industry is not back with the usual utilization level of last year.
How are you looking at margins?
Why cotton is losing market share? I will tell you a practical example. In Tirupur, 100 rupees, 150 rupees t-shirts used to sell in large quantities across India. Tirupur makes and sell across India. We used to call this as a domestic low-end consumption story. Entire segment shifted to polyester and filament yarn. They are no more buying cotton-based yarn or fabric. They are simply buying filament-based polyester and cellulosic fiber fabrics due to the cost advantages. Around 1,500 crore worth of business shifted to synthetics. Across India, mills also started running several products, including blends. In 2 days back in your own channel, India's one of largest retailer told they are facing still inflationary pressure in the market. The answer for that is they are making more blended garments. They are asking suppliers to supply more blended garments at the lowest possible prices. Lowest possible prices is possible only with the blends. It's not possible with pure cotton. So cotton is steadily losing market share. We need to account the lower utilization level, shifting of products. And third, apparel exporters are running at lower utilization level. They are not so confident about achieving 100% utilization in the immediate months.
Okay. Mr. Damodaran, we also had Cotton Association of India come and tell us that they are expecting prices of cotton to go to 75,000. They also said that India perhaps could turn into an importer from an exporter. How would you look at those kind of statements?
Madam, in our opinion, as an industry association, it is highly speculative comment, and even industry is not so happy with that comment because now for these prices of cotton, these prices of yarn, international buyers are hesitating. They are buying from Vietnam. If we imagine such kind of a 10,000-15,000 higher prices from this level, naturally utilization will again come down. Mills can't make continuous losses for month on month. We feel that because of lack of data, and this is a usual playbook of cotton trade. Every year they used to start with non-season. They used to tell the entire cotton trade. I am telling the crop will be less. India, we can't get cotton in India in the end of the season. The last year also the same story played out. Finally, spinning mills lost 2,500 crore by way of importing cotton, and prices crashed again. So we can't agree with that kind of a price range. That is not possible. Still, international, domestic, all markets are facing inflationary pressures. Demand is not so visible because we are working in the retailer end. We know how the retailers are demanding. Tesco yesterday announced that they released a public release that they are urging suppliers to reduce the prices. Every international retailer, domestic retailer, while coming for the negotiation, they are asking a first question, how much you reduce the prices. So it is not at all bullish trend. So these numbers, because of lack of authentic data, anybody can play their guesstimate, ma'am.
Okay, all right, Manisha, thanks very much for that. So that's the update coming in on cotton prices. For the markets, like we've mentioned, it's more about the broader markets today, and the Nifty has also recovered a lot in terms of, in terms of the day's low. So there is some amount of buying which is taking place at lower levels, but separately, it is the mid-cap index which is really shining out. So currently, furthered in terms of gains at this point in time at the high point of the day, up around 0.7%. It's a wrap on Halftime Report. Business Lunch will take all the action forward. Stay tuned.